But let's talk about who these people are. I think the first one you mentioned was business owners, right?
Right, exactly. Business owners, which of course is part of that self-employed borrower profile. And the issue with business owners, you've got different types. A business owner, oftentimes, if it's a small business, particularly a sole proprietorship, then most likely they're not even incorporated. They likely file a Schedule C with their tax return. That document, that form in your tax return, profit or loss from business or profession. So that gets used to qualify you. But again, you have that same problem of we can't use the gross, we have to use the net. And in most cases, a business owner who is a sole proprietor filing a Schedule C, almost always there's no salary they're paying themselves. So it's all based on, what is that bottom line net profit? And again, because they tend to be aggressive to avoid income tax, that bottom line usually is going to be too low to get you qualified. Now, in some cases, a business owner, even if it's a small business, may have incorporated, most commonly an S corp, where they may have a salary they're paying themselves, and so we can use that, and we can use the gross amount, but we still then add to that the net. And again, the problem is the net income generally tends to be too low, and in many cases they can't meet the debt ratio. So that's one of the types, but there's others. Another term you hear a lot about is people who are gig workers or they're freelance workers. And here's a couple of good examples. Uber drivers. That's a common type of borrower profile now that we see. Those people tend to be paid not on a W-2 salary basis, right? Obviously. And so can be challenging to get them qualified. Another borrower profile that is pretty common, and I think actually is a type of borrower profile that is a major component of non-QM loan programs, is real estate investors. There are people out there who own several rental properties, and they can have trouble getting qualified for conforming loans because, again, with them, they're going to have Schedule E that'll list their rental property or properties, and they may have a lot of expenses they're declaring against the rental income from those properties, arriving at a net income that, even when we can add back the depreciation for the property itself, the resulting amount is too low to get them qualified for the conforming debt ratio requirement, the ability to repay requirement. So that part of the non-QM space is the real estate investor is a big part of the non-QM space. In fact, a specific loan program that's used for them is what we call DSCR, debt service coverage ratio, where for a real estate investor, you're qualified solely on what's the mortgage payment that is going to result from the loan amount you want, compare it to the rental income. If it's a break even or better, that's how you're qualified. You provide no other documentation at all, including if you have a job, that's left off the application entirely. You don't put down your employment. You don't put down your employment income. It's simply, is it break even or better?